All right. So, what is up, everyone? Paul Apostolakis, Salvatore Kuzmano, Brad Weisgerber. We are inside real estate. Some of us are inside our homes. Brad, I don't know where Brad is. And we also have a very, very, very special guest, Kevin Peranio. He is the Chief Lending Officer of PRMG. And just to preface, if those of you that don't know who he is, PRMG and Kevin have really come out through all this turmoil and kind of been a really good voice of reason and information for the community of lenders and people that are looking to get information. So Kevin has done a really, really good job with his videos and, trying to give people a perspective of what's going on, because even people that are in the industry, that have been in the industry for years, like myself, it is hard to kind of weed through what's going on. So we really wanted to bring someone into the podcast and that could explain it, because this shit's weird. Like, there's a lot of weird things going on. So Kevin,
really
thank
weird.
you for doing the show, man. I really appreciate it.
Yeah, thanks for having me on. I really appreciate, trying to get more communication, education out to your audience, brother.
Yeah, man. So our boys film. This is the craziest thing about what's happening. So Zoom, you can do it from anywhere. Our boys in his Tesla, which is amazing. By the way, I want one. Right. So, yeah, dude. So let's just get into it. I want the audience to understand, just to frame it. If you aren't obviously aware, but most people are. We're going through some financial turmoil, and
really,
yeah.
Nobody knows that.
Yeah. So I don't know. I mean, the people that are listening to our show probably are the ones that don't know. Anyway, so so the reality is that the mortgage markets, people were thinking rates are low because there's money going to the bond market. Even people in the industry, then all of a sudden rates started going up, and then people started hearing there's liquidity issues, meaning that people couldn't, there were margin calls, and there's all these big words, and it was chaos, right? And so from your perspective, just to kind of give like a insider view, what was happening that was causing so much stress on the system?
So let's start with, we were coming into this time period with fantastic housing, awesome job market, incredible economy, arguably one of the best ever. And some dude in Wuhan ate bat soup. And, now the whole world is in a global pandemic. And so, we're dealing with disruption. And what's interesting is that the disruption really started in the secondary market. I mean, you kind of hit the nail on the head. I mean, when people realized that jobs were going to be lost, people would default, people wouldn't make payments. It really kind of messed with the foundation of housing. And so, you guys over there, and what the part that I like the most is we're helping people in our community. We're helping people get a home. We're helping people save money on a refinance. But the secondary market is a different animal. And, think of it like Wall Street. It is, we buy and sell money. We buy and sell money. And the secondary market is cold, heartless, and unforgiving.
Unforgiving.
And so
it doesn't give a shit, right?
Doesn't care.
Yeah.
Doesn't care about the business you built, how long you've been there. Doesn't matter what channel any of us are in. It doesn't matter how big, how small. Money needs to have a return in mortgage-backed securities, which is what we're part of. And we basically are creating securities. We're creating one of the safest asset classes in the world. Let's just put it that way.
Yeah.
And so people buy mortgage-backed securities. They buy bonds, and it's backed by homes that hold their value and borrowers that make their payments.
Right.
And so, people stop making their payments when, they lose their jobs or are on furlough, or the government says you can get up to 12 months free. So that disrupts everything. And so, there's just a lot. There's a lot that's all happening. I mean, before even the lockdown, rates were getting lower. And so the worry was like, okay, well, if you do a loan at 4% today, literally in 3 weeks, someone can refinance, at 3%. And so
how are they going to perform at that point, right? There's no way you're going to perform.
Yeah. It's so prepay speed is the way the secondary market looks at it. Like, people pay money to hold these bonds, but they expect to hold them and get paid on them for some period of time. Lenders lay out a lot of money for the process it takes to get. It's still a very lengthy manual relationship process. And so it costs money to do that. And unfortunately, if a loan pays off, for the benefit of the consumer, I mean, they get a better rate, but if it pays off within 6 payments to their servicer, that's the secondary market has a real problem with that.
Yeah.
So they just say, okay, well, this stuff's worth less, not worthless, but worth less.
Right.
Why would we pay for these bonds when you guys are just going to pay off? Okay, well, now why are you going to pay for these bonds when you're not working or you're on furlough? Okay, why are we going to pay for these bonds when you get back to work, you still might not make a payment for 12 months? So it just like all these things just keep stacking on.
Right.
And it just causes so much disruption.
It's wild because you're having, and Sal, you're more on the origination side. Brad, obviously you're on the back end with our lines and everything, but
I'm sorry, Brad.
Yeah. He's the guy. Yeah, he's the guy.
Yeah, it's been fun.
Yeah. It's been interesting. So basically, and we as a business were like, oh my gosh, rates are low, and then all of a sudden there's like chaos, and blocks that we thought we had were gone overnight, and the market was changing by hundreds of basis points per minute, it felt like, right? And a lot of people, Sal, that we talked to just didn't understand that. The media, first of all, they're so fucking behind. It's by the time they were announcing the rates were low, they were up, and then by the time they were like, oh, they're up, they're like, oh my god, there's just.
Well, how are you supposed to explain to someone who you just closed with at 375 who thought that was an amazing rate, right? How are you supposed to explain to them that I'm one, right? Like in any condition, let's just say it's a super healthy market. I'm not able to refinance you, or I can, but I got to work it out on the back end with my lender so I don't get a $7,000 check in the bill in the mail. Yeah. But 2, now it's this, right? Well, my bank says that they are offering this, right? And they can take it. The bank potentially can do it, and wholesale lenders are anywhere from matching or beating that bank all the way up to a 1.5 higher in interest rate. It's just like it's hard to explain to a consumer what's going on, but I think a good thing for loan officers in this industry right now is, hey, if you're considering a refinance, why don't you wait for things to stabilize, right?
Yeah, it's really strange. I mean, normally different investors or different wholesale lenders, they're priced very similarly, right? There's maybe a quarter, 25 basis points here and there, but right now there's a wide variety of pricing discrepancies. Like you said, Sal, it could be a 1.5 different or 1.25 different
from investor to lender.
From lender to lender. It's really wild how much instability there is just from one institution to the next. It's kind of crazy.
And that's actually one of the primary reasons I wanted to bring Kevin on is I think he has some really good insight on that. And Kevin, I think you could speak on this more than anybody. Like, obviously, from our side where we have options of where we can send our business, and we have all the different price sheets. You started seeing massive disparity between all of them, right? So what caused that?
There's 2 main drivers. So there's underwriting, capacity at a lender. You can only do so much, right? And then of course there's your cash capacity, your cash constraints as a lender. And so let's address the first one. So in the entire country, there's about $11 trillion in mortgage-backed securities, and end of February, beginning of March, the estimate was that $6 trillion was eligible for refinance, that it made sense for the borrower to do a refinance. So last year was a big year for the industry. It was about 2.2 to 2.35 trillion in financed mortgages for the year. Like, if this industry is running hot and super, overtime, efficient, everything, just pure overdrive, I'll probably get about $3 trillion in loans done in a year. Well,
that's max capacity, right?
In a year.
Right.
Okay.
Right.
So March 1st, when rates hit an all-time low in the history of all time, for that 1 week, okay,
yeah,
$6 trillion in loans were in 4 days. $6 trillion in loans were available for refinance, and the locks started coming through.
Yeah.
So the industry just can't handle it. So I'll give you an example at our lender. So there's 2 guys that founded our company, Paul and Robert, really good dudes. We've been around since '01. I've been with the company almost 10 years. I've been a partner in the company about 4 years. So I moved from the East Coast, where my whole team that I've been with my whole career was kind of helping and serving communities out there, wholesale, retail, mini correspondent, and delegated. So the two founders are like, all right, dude, you're a little bit younger than us. Why don't you come help us run the company? So I moved down here 4 years ago, and then we brought in another guy named Gary Malice. And he is phenomenal. Like, I'm sure you might have seen him in some of the AIM Brokers Are Better podcast. He did a Facebook Live with Anthony Casa on Monday. Capital market strategy guy, super brilliant guy, got an MBA, he's from Chicago. Totally not a sales guy, but an effective communicator about very difficult topics. We've never seen this kind of disruption, but we were feeling really good about our marks. So in February, we took $1.2 billion in locks in February for the whole month, which for us was $700 million clear of February the year before. Usually February is the coldest, crappiest, shittiest month of the year,
Yeah.
And January and February were killer for us, and it was awesome. The first week of March, just the first week of March, we had another $1.2 billion in locked loans, so forward commitment loans.
Right.
So that just goes to show you how much the volume. I mean, we could easily have quadrupled if we wanted to.
Right.
So our constraint was underwriting capacity. I have a couple centers right now. They're at like, if you count registration time and underwriting time, I have a couple centers. We have like 6 centers. Some are at like a week turn time on refinances. Some are like 4 days on purchases. Some are at 2 weeks to get a decision on a refinance.
Right.
So our underwriting capacity is where it is. And so for us to not take every loan in the world that's eligible for refinance, all $6 trillion at once, we are limited by the ability to get the loans out the door.
Right,
so
right.
we raise our margins. And so what was interesting is that very first week of March, we noticed, so let's just say the wholesale channel or non-Del Core channel you guys are in that we also service. United Wholesale is a monster, biggest wholesale lender out there. Home Point, they're enormous, probably arguably number 2, right around there with Caliber. We noticed both those lenders took in so many locks in those first couple days of March.
Home Point just opened it up, by the way. They didn't care. I felt like.
Well, what's interesting though is that they both backed out on price within a couple days. So they kind of hit their limit, and they're bigger than we are. So we started getting their overflow, and we're totally cool with being, a privately owned lender. We did $8.3 billion last year. It's not small, but it's not large. It's not medium, but it's maybe a little. It's like medium to large. So we're okay. We don't have to be number one. We don't have to kill anybody else.
Right.
We just want to do good business.
Yeah.
So we were like, oh my God, like we just got $250 million in locks in one day, and then the next day another $250 million. We're like, okay, our underwriters are going to kill us.
Yeah.
So for us, there's underwriting capacity, and so when you see different fluctuations on the rate sheet, you got some people saying, okay, this is all we can handle. Oh, maybe I can handle more. Or, hey guys, lock for 45 days. Okay, lock for 60 days. We'll get to it later. And then you're the one. You guys are the one stuck telling the client like, yeah, I know. We were supposed to close last week, but so we try and mitigate that for you as much as we can. But look,
but it's a wild time. People kind of have to understand that it's like, dude, like I told people, like you got to just get your deal closed.
If you didn't see the writing on the wall, which most of us did, and I'm sure not many did, right? Obviously, like the rates, and we're watching this 10-year go from 1.5, 1.4, 1.2, right? And everyone is getting like giddy, right? Like everyone's like, wow, like we are about to write $20-30 million here in our own little shop, right? Everyone can refi.
And you still will. It'll just take a little longer.
Right.
That's it.
Yeah, no, I mean, listen, we have a pipeline of loans that will eventually get a lot commitment, right?
So Kevin's, go ahead.
But I think what a lot of people did, right, because it was a weird moment where the bond kept going down and then the inverse happened, right? So a lot of, me included, would, hey, let's wait to lock, right? The bond is like bleeding every day.
It will catch up.
It's going to get better. It's going to get better, right? And then all of a sudden, boom, this refi that was paying us even minimal, right, at what we could do is now costing $4,000 with no comp. So, And I think that hit a lot of people. And unfortunately, probably a lot of underwritten loans that were never locked that probably won't ever close. Not while they're submitted. They got to get resubmitted.
That doesn't help the capacity issue for underwriting either.
No.
So.
Lots of loans are being underwritten that aren't closing.
Right.
So that's half the battle. That's half the battle. The other half is people are constrained by their cash capacity.
Mm-hmm.
So lenders only have so much cash on hand. It's to be in this business as a lender, cash is king.
Mm-hmm.
But nobody has unlimited cash. You know who we probably all think of that has the most cash out there? Let's say Wells Fargo, right? They're enormous.
Yeah.
Okay. So we sell some loans to them, and last week they said, "Hey, we're not doing any jumbo loans."
Yeah. Oh, yeah, the jumbo loans. Yes. Yeah.
No jumbo, right? So we're like, aren't you like the biggest bank in the United States, or arguably one of the biggest banks?
Yeah.
You guys are pulling back. So the thing is, like, cash isn't endless, and some people like to hit that limit with their cash, and then just kind of deal with the outcomes. Some people don't understand how your cash can be limited. So you touched on margin calls and stuff like that. I mean, so on the backside, remember how I started this conversation. This business is buying and selling money, and those mortgage-backed securities are when rates get so low, and Sal gets excited about refinancing every borrower he's ever talked to. Servicers freak out, thinking every loan that's on our books is going to refinance off my portfolio. That's an asset on our portfolio.
Yeah.
Now, for our company, we're not a big servicer. We hardly even 10% of our book that we even bring in, we service. We are very diversified as a company. 3 channels,
Smart.
multiple executions, some retained, some co-issue sale, bifurcation, assignment of trades, bulk, hybrid, selling whole loans to aggregators. We do different executions on the secondary market, and we feel good about that. Having said that, it's still very disruptive. I can that when rates get as low as they do in the secondary market, when mortgage-backed securities are trading for all-time low prices, which they are still, even this kind of gotten back down to it. Every loan that we locked back in February that is a higher interest rate, our as a non-bank, when we take out those positions on the secondary market, those trades, our hedge, if you will, our broker dealers are going, hey man, remember that 1.2 billion you locked in February? Well, it's the first week of March now, and every single loan you locked in February is basically 200 basis points worse in pricing. So we're going to need you to put up a little thing called a margin call. So They just want to make sure that the positions that they sold on your behalf, that you're creating your hedge, is going to pull through. Because it's possible that, Paul and Sal and Brad's of the world say, well, my consumer, now they want this other rate. And I know I lock with you, but I need this other rate. So lenders got put in a really bad position, and we still are. I mean, we're still in a cash position. I can tell you, our company, we have $34 million sitting out with multiple broker dealers out there. I mean, it's part of the game. It's just part of the game.
Right. Yeah.
What to do, there's rumors of lenders all around the country, how much they're putting up, 600 million, 700 million, $1 billion. And that money just sits there until the loans in the pipeline close out, which we're very confident they're going to close out. So there's a cash constraint. So now so just using my lender as an example, I'm being totally transparent. And I think transparency is so critical right now.
I love that.
So we put all this money out, it's sitting out there, but we have warehouse lines. And these warehouse lenders, we have 5 warehouse lines, right? And so they're saying, okay, well, that's great that you have $34 million in broker dealers accounts, but where's our protection? You want to fund more loans? So you have all this money over there. Well, that's not good enough for us. Those are pledged assets. So where's your cash to make sure that we feel good as a warehouse lender, giving you the ability to fund $1 billion a month? So we have to have at least 30% of our net worth, which is pretty high. One of our warehouse lenders, is one of the higher ones that requires that total net worth cash covenant. But we have to have additional cash on top of those margin calls sitting in what's, like either our operating account or a pledged account. So for that warehouse lender. so those are things that we dealt with, and we dealt with it. We're fine. Like, we're big boys, like this is what we do.
Right.
We have the cash. We play the game. We had a record month last month. We funded $984 million. We're projecting 1.1 to 1.2 billion this month. First time we ever hit billion in a month.
Wow.
And we'll get all our we think we'll get all of our margin call money back by the end of the month. So it's another 34 million come back, in our account. And so we feel like, for us, the way that we've managed our money and our pipeline and our cash capacity and our underwriting capacity, we haven't missed any wires. Anybody that asks for a wire, whether in our non-del core channel or wholesale channel, they all got their wires. If they made wire cutoff, they got their wires. Our VOE policy is within 3 days of disbursement. So, we feel good about where we feel we're offering a good service. And so for us, but having said that, there are still, so that's when you hear capacity and turn time, look what they look like. Every lender is fighting different battles. And so the thing is, there are unknowns that happen. There are things that you can't account for. So I'll give you an example. So we sell to a very large aggregator. I'll give you one more example, and then I'll yield the floor back to you. But so March 1st, let's say March 1st, March 2nd, that record week, lowest interest rates ever, right? We're locking loans right and left. We're all pumping our fists. We're, like you said, we're all giddy. Like, we're excited too.
The party. Yeah.
We're originators at heart. Like, man, we're going to serve these communities. We're going to do more loans. Everyone's calling me back. This is awesome. I feel so good about my job. So you lock an FHA loan, great program backed by the government. You lock it on March 2nd for a good rate for a borrower with a 600 FICO. And so March 31st rolls around. It's the last day of the month, and it's, all the purchases get done. We funded $100 million the last day of the month. Fantastic lenders out there were having record months. UWM funded $2 billion in one day. I mean, people forget.
Yeah.
I mean, as much challenges as everyone's facing, they funded $2 billion in one day, which is insane how many people they serve.
And Kevin, they had to move 5,000 people out of their offices at the same time. I don't know how they did it.
Yeah, that's crazy.
Thank God we were mostly remote anyway. We didn't miss a beat. But yeah, I mean, kudos to Ishvia and Alex and Melinda and the whole team.
They crushed it. Yeah.
They're great people. So think about this. Back to that example. So we turn around and we sell this 600 FICO FHA loan to this lender who we always sell to, one of our biggest aggregators. And on the last day of the month, they say, oh, by the way, everyone, if you have an FHA loan you're sending to us, there's a 15-point hit for FHA loans now for FICO 600 to 619. And you're like, excuse me? That's 1,500 basis points. If the FICO is 620,
what?
It's a 10-point hit, which is 1,000. Now I can promise.
But it's not funny.
It's insane.
That's insane.
It's kind of funny at this
that's
point.
That's fucked up, dude.
I mean,
So on March 2nd, when we took in all those locks, best rates in history of all time, did we model in 1,500 extra basis points? No. So we're like, all right, well, I guess we're not selling to that guy, and I understand him. It's like, so I get it. They're dealing with their cash constraints. They're sitting there going, wow, like now every borrower can get free 12 months payments, and they're losing their jobs. They might not pay, and rates are lowest in history, and they might pay off sooner rather than later. Like, they're protected. And so cash, it rears its ugly head in all these different ways. This servicer does this and they do that. So many different things.
Downhill.
It does,
it comes from Saudi Arabia with these guys buying these MBSs all the way down to me sitting in my chair, basically eating shit sandwiches every time I talk to a borrower.
It's better than eating fat soup,
Yeah, but your shit, Sam,
I'll take it.
Sal, wasn't 1,000 basis points over the next, how much that would have
No, it was just zero originations.
That's all it was.
Yeah. But it does roll downhill though, because something like that changes your underwriting policies, right? So now you're a little more restrictive. I'm guessing if it was me, I'd be a little more restrictive on, the FHA deals in our pipeline, right? We're going to put a cutoff time on these lower FICOs. We're going to put stricter guidelines on them, which we've seen from some of our other investors that loans that are still in process that have locked on March 2nd that didn't want to close yet or couldn't close yet. They have a cutoff time now, or like these FICO buckets where you got to close this loan or you're going to not be able to close it because we put restrictions on it. You have to close it by the 15th of April or the 30th of April. We're not going to honor it.
Yeah, that's not our bag, man. I'm telling you, right, like Gary, who runs our capital markets, honoring locks is such a big thing for him. For us to not honor a lock it means there's absolute, complete and total chaos. So like when non-QM just evaporated, literally like within a week, just disappeared off the planet.
And just so everybody knows, non-QM is like non-traditional, just not Fannie, Freddie, or backed by any big agency.
Right.
Yeah. When Dodd-Frank passed, they said, okay, we're not going to do subprime loans ever again. We're gonna call something a qualified mortgage, a QM loan, and anything that's outside of the securitized by Fannie, Freddie, Ginnie, regular conventional loans, FHA, VA, USDA, anything that's in these other areas, we're gonna call it a non-qualified mortgage. So look, just because someone had a bankruptcy 4 years ago, they got to wait 7 years. I mean, maybe they've already reestablished themselves.
Right. If
they're willing to put 20% down, does anybody really? I mean, okay, fine, yeah, go bad again. I'll take your property over. I'll get equity in it. So
yeah, there's fail safes for sure.
Yeah. So all this private money stepped in, and then when private money's there, the securities, the mortgage-backed securities, the cold, heartless, unforgiving secondary market, it's not backed by Fannie Mae or Freddie Mac or Ginnie Mae. So it's backed by private securitization. And all the guys who bought that paper, they're like, yeah, I don't think I want to buy a loan that might have a guy 1 day out of bankruptcy. Like, now's not the time to use our capital like that. And so literally overnight, we had loans in process for like, if it's not funded, sorry. I'm sorry. Like,
so what'd you do with those deals that you had?
They're dead. They're all dead. I mean,
Nowhere to put
there's
them.
so when I say this, when I say there's nowhere to sell them, there's nowhere for a lender like us to aggregate large amounts and then turn around and give them.
Right.
I hear stories of like, this bank is doing a couple here and there, or this one's doing some here and there. Okay, yeah, we're still in business, 50% max LTV. Hey, we're still in business, but we're only so people are kind of trying to get their footing. And what was interesting is, all right, everyone's kind of like, okay, yeah, I guess a guy 1 day out of foreclosure, probably not the best use of our capital. So you're kind of like, okay, guy, hey, buddy, just wait till the end of the year or midsummer. I think that market might come back. You have nowhere to go anyway, so just keep in touch. But then everyone's like, okay, well, what's the next loan like that to happen? Well, jumbo is also private securitization. Chase buys a lot of it. Wells buys a lot of it. They create what's called non-agency loans, right? Because jumbo is not a Fannie, Freddie, Ginnie agency loan. It's a balance sheet play. You fund this $1 million loan, you package it up with another 400 of them, and or 40 of them or whatever, and then you have this nice big security and you sell it on the market. Well, everyone thought, well, that's private securitization, so that's probably the next one to go away, like non-QM.
Right.
But it was actually government lending, which was next.
That's what I wanted to bring up to you. So something interesting happened because all of a sudden nobody wanted an FHA loan. That was very interesting. And so talk to me about that whole thing, because that was weird. It was all of a sudden it was like FHA is horrible, no government loans. These are the numbers look crazy. So what happened on that side of it?
So when Dodd-Frank created what's called QM versus non-QM, a qualified mortgage, there was basically a waiver that said, okay, if a loan meets the DU findings or LP findings, the automated engine, the guidelines put out for FHA loans, Fannie, Freddie conventional loans, USDA, VA loans, if it meets the guidelines, we're going to consider it qualified mortgage. We're going to make a waiver. The FHFA, all the regulators, everyone got together, all the people buying mortgage-backed securities. They said, you know what? If it's backed by Fannie, Freddie, and Ginnie and the explicit guarantee of the government, which, Fannie, Freddie's still in conservatorship, then we're okay with that. Like, we're going to consider it a qualified mortgage. Now, you and I both know you could get a 550 FICO with a manual underwrite, someone who's got horrendous credit, but they can tell their story. Well, I went through a divorce, I'm a single mother, and I had this issue, and I know my credit looks bad, but my ex-husband's a jerk, and he just ran up the bills. look, I've reestablished, I'm on my feet, I need this house. And so you and I in the community, we do those tough loans. And that is considered a good loan. Now, some would say that would be considered basically the new subprime. And so there was a lot of talk about how far credit should be extended. So let's take someone that's not a manual underwrite, 56 debt to income ratio, over half their income, their gross income, pre-tax, by the way.
Pre-tax, right.
Goes towards all their debts.
Yeah,
right?
It's crazy. Yeah.
So these are
$1 over the amount needed to close.
$1,
no reserves.
right? Yeah, no reserves. Only 3.5% money down, which can come from a gift. So it's not even your own money.
Right.
These are things that you and I, we all love to do because we're helping people get into a home, which is such it's such a big deal to be a homeowner versus a renter. You have to do it to create even a shred of wealth, not only for yourself, but for generations to come. But many people in the cold, heartless, and unforgiving secondary market have looked at government lending as basically the new subprime. And so when we go into a recession, which we're in now, when you have unemployment.
So you think we are in, just not to jump on.
Oh,
I agree with you. I agree with that. But there's some people that are still saying that maybe we're not. I'm like, it's weird. Anyways, go ahead.
We're 100% we are.
Yeah, it's crazy. It's like, what are you doing right now? Where are you at?
The technical definition is 2 quarters in a row of negative GDP growth.
Right.
I think we were kind of clipping along at 2% GDP growth January and February, but March, the bottom dropped. The Great Recession.
Yeah, I know,
the
dude.
greatest one of all time had 10% unemployment back in 08 and 09.
The Great Recession, right?
We hit at the end of March 28th when that 6.6 million jobless claim number hit for a total of 10 million jobless claims in just 2 weeks. We hit 9.3% unemployment through March 28th, and we're not done, by the way.
No,
there will be more job losses and more furloughs, and so I would think we are. So government lending is being attacked on different fronts. Will the loans perform from the past? Will the job losses from the past affect everyone? Oh my gosh, now we have record low rates. So the ones that are performing, they're going to want to pay off earlier and get a lower rate, get rid of that mortgage insurance that's packed in there, and so that hurts servicers. So now they're licking their wounds. When people don't make their payments, it's a very interesting thing specific to government lending. Bondholders get paid no matter what. So if you buy a Ginnie Mae bond, which is a mortgage-backed security backed by an FHA loan, you're a bondholder. That's a very safe security, and the reason why it's safe is because the servicer guarantees you get paid. So if the borrower doesn't make their payment, right, you got to make their payment for them, on schedule, right? So there's an accounting term called scheduled actual. As a servicer, so we have about 3,500 loans, not a lot of Ginnie Mae loans, but when our borrowers don't make their payments, we have to advance their principal and interest for them. So we have to make their payment for them. So that was already kind of getting shaky about government lending. And then the stimulus package came out like 10 days ago, or almost 2 weeks ago.
Yeah.
And they said, oh, hey, yeah, man, 12 months free payments, no questions asked. What? So all the servicers freaked the fuck out. They're like, are you kidding me? So now, look, don't get me wrong. If you lost your job and you're in a hardship, of course this is who it's for. But there are some people that will abuse it. There are some people that don't realize it's not forgiveness, right? If you go into forbearance, you still owe that money at some point, right?
Yeah, if you look behind me right here, Kevin, that's exactly what it says. Because I think I just want to quantify that, because I think just to make sure that people get it, like the money that you aren't paying, somebody has to pay, and nobody is getting off the hook at all. So you're not going to get off the hook, really.
Yeah,
right?
Yeah, not at all. And the servicers have to make those payments on your behalf.
Right.
And so the value of mortgage-backed securities for government lending went down even further because of forbearance, because you just going to have people, from the past loan. I know, like Mr. Cooper is a really large servicer. 86,000 people are in forbearance now. And it's been a week. In 1 week of them rolling it out, that's 86,000 borrowers. They're making the payments on their behalf.
But you know the craziest thing about the whole forbearance thing that I don't think people are understanding is that the rule right now is stop making your payment and we'll let you know after 3 months what it all means. Because realistically, there's no like, yeah, you can't impact your credit, but it doesn't mean that it won't say like forbearance or modified or whatever.
Right. When's it due? What are the terms? What
Right.
implications does that have on a borrower? Simply just avoiding a uncomfortable payment or potentially foreclosing on their house. Everything right now, every issue that we have that we're dealing with comes down to, in my opinion, this stimulus being effective from a standpoint of people being able to afford their homes, right? Not necessarily a $1,200 stimulus check, but more or less the SBA loans, the PPP loan, which we talked about earlier. If these programs aren't effective, people won't be able to make their mortgage payment, which costs servicers obviously tons of money, right? Continues to make MBSs more or less attractive, right? From a non-performing note standpoint. I mean, it's bad stuff. So the government, I think, just has to put every focus on keeping income levels where they were until this is over.
But you've got some industries like the hospitality industry. There's not, I mean, that whole industry could be just changed forever. Like, you know what I mean? Like there's
going to be,
yeah, we're not going to be living in the same reality. So I guess, to your point though, Kevin, like if all these things are happening, right? Where are we today and how are we, because I have noticed that there are resolutions, but just even for the forbearance thing that we just talked about, right? Quicken Loans, when you think of Quicken, you think they've got, they do have a few $1 billion in the bank. They're very lucrative. They own all of Detroit, but they couldn't even take a bleed like that if like they had to like do their, let's say 50% of their book. They wouldn't be able to make that bleed.
Well, it's interesting you bring up that as an example because they're a very big servicer.
Right.
So a lot of their net worth and a lot of their revenue stream comes from their existing servicing portfolio. So the value of that portfolio was downgraded. So the secondary market said, okay, servicers, you guys are holding these bonds and you're holding servicing, which you're putting a valuation on. Let's just say, for example, they said it's worth like a point, right? 100 basis points times their entire book, whatever that is on their balance sheet. So you want to talk about it, a margin call. So there's margin calls on the front end locked pipeline going forward. You take out a hedge position, you fill the trades, you get your money back on that float. There's also margin calls against people's servicing portfolios if you have debt.
Almost lost you, Kevin.
My bad. No, I'm still here. You got me?
Yeah. You've got to get that Tesla too.
Okay, I'm sorry. Yeah, man. You know what? When people call me, like Zoom doesn't block incoming calls. It's so annoying. So anyway, so when people have a servicing portfolio and now it's worth less, your balance sheet and your net worth is now less. So if you have warehouse lines based on your net worth, you have to come up with more cash to keep the same funding capacity on warehouse lines going, right?
Meet those covenants.
So there's margin calls. That's right, to meet those cash covenants, which Brad.
Yeah.
You manage the lines at your company. So be thankful you guys don't have a portfolio. I mean, I saw on some portfolios, some hedge advisor and MBS advisory firms. They said, okay, whatever Ginnie Mae portfolio you might have, reduce the value by 250 basis points. In any conforming loans, Fannie Freddie loans you have, reduce the value by 50 basis points. So let's just say, for example, in that, if you valued your portfolio at 100 basis points, right? Well, now you probably got to bring it down to like 60 or maybe 50. And so that's a big part of your balance sheet. So now you've got warehouse lines based against your net worth, which was founded on a servicing portfolio, 30%, 40%, 50% less. You still have cash. You have other things on your balance sheet, but that part of your balance sheet just got cratered. Right. So
huge hole.
Now let's take it one step further. So let's say that you're a lender that takes out money, working capital lines. You take out a cash out lien against your portfolio. All right, I have $1 billion portfolio and I want to take out debt against that to raise capital so that I can just continue my operations or buy more mortgage-backed securities. Well, now those guys that lent you that money, you have debt against this asset that's worth 30%, 40% less. We're gonna need you to put up more cash, or else give us our money back that we lent to you earlier. So there's all that, and then there are some lenders out there that have a business model where they fund these loans, they hold their servicing MSRs, mortgage service release. They hold these MSR and they just sit there and go, okay, I'm gonna wait around and bid out to the highest bidder. Well, you were holding an asset that just got whacked. Maybe it's worth 30%, 40%, or 50% less.
Right.
So now you're going to get less cash for that. Plus you spent cash to create that portfolio, that MSR that's sitting out there held for sale.
Right.
I mean, there's a lot of things, and it's not a show game. The whole economy, the whole world is leveraged. It's lever, right? Look at the stock market deleveraging. Look at our treasuries, all this stuff. So look, I mean, there's still an underlying asset, and everyone's just trying to figure out, like, all right, well, where's this forbearance policy? Yeah, what's it worth? Like, okay, is it 15% of all borrowers are going to be under forbearance, and then that's how much you have to pay? Is it 20? Is the unemployment going to be at 20%? Is it going to be at 42%? So there's uncertainty in the markets, and the cold, heartless, unforgiving Wall Street secondary market, they don't like uncertainty. They like cash.
Right. It's well, I think, look, the system worked very, very well. This was an anomalous type event that these are like those like really like fine like dotted lines at the end of something that like you never read, that would like never happen, right? Like
it's a black swan event.
Yeah, it was a black. Yeah. Right. It's a black swan. Like it was just it's just, this is not a typical thing. Now, my perspective is right now that we can't sustain this type of turmoil over a 90-day period more. I think if we start extending past that, it's going to get really fucked up. What do you think about that?
Yeah, I mean, it's interesting because I think everyone's very hopeful that we're going to get out of this thing and move forward very quickly. And I'm actually a very positive person. I'm not a negative person, but I feel like we're gonna come out of hibernation a little groggy. There are people like you guys mentioned. You mentioned hospitality workers. Out of the 700,000 net job losses, so the non-farm payroll report that comes out, the unemployment report that comes out the first Friday of every month, that came out last Friday, that only takes data through March 12th. So it didn't count that 2 weeks of jobless claims. Totaling almost 10 million in jobless claims. Yeah. But with the net, so typically we lose 700,000 jobs a month. We add 1 million. We're net 200,000 plus jobs. We net lost 700,000 jobs last month without counting the 2 worst weeks of last month. Right. So of the 700,000 jobs lost on that report, there was 500,000 in the hospitality industry. Now, most of those people are younger. They're mostly in their 20s. They haven't found, Omega and realized that working for a local lender like you guys is a way better gig than slanging drinks, And look, we all go through that phase, I worked the snack bar in college at a country club. I did it. I get it, I did the short order cook stuff, but it's not a sustainable career. And they're the first ones to get whacked, and it's mostly younger people, and it sucks, and it's a lesson learned that, when shit hits the fan, there are certain things and criteria to meet as a society member that, it puts you at risk. And so, yeah, it sucks learning how to do credit reports and all the TPS reports and the stuff you do when you first start this business.
TPS reports.
But once you get through like that first couple of years of grinding it out and learning shit, you can get to a point where you have a sustainable career. What's great about our job is we have been deemed essential by the Secretary of Treasury, Mnuchin.
Yep.
Literally, I have a letter that says, we're essential. I have the letter, and so we're literally on the front lines trying to help, the bars get out of this mess. So for me, I think, you see all these jobs lost, and everything that's gone on. It's absolutely insane, and it sucks. But it really sucks if the jobs lost and the furloughs are for people that own homes, because they're getting they're getting whacked. They're getting another thing, just to say, who got relief? Homeowners. If you're a homeowner and you have a mortgage payment, you got up to 12 months forbearance. You know who didn't get shit? Renters.
Nothing.
Renters. The only thing renters got is you can't be evicted for 120 days, but you still owe that rent. So if you're a renter, you're 25 and you're a waitress,
right?
The government basically said, you know what, you'll be okay. We'll get back to you later.
Yeah.
And what a message, to be sent by our own government. But, again, the secondary market, they're running out of cash. It's cold, heartless, and unforgiving. And there's a lot of lessons learned, and us snapping back out of this thing. It's going to take longer than people think, but when the recovery sets in, it's going to be a very powerful recovery.
I agree with that.
I'm interested to see. So, like, back from the mortgage collapse or whatever, the bubble back in 2008 and 2009, when everyone was underwater, right? It took a couple of years, but they came out with HARP, right? A lot of people to refinance that were brutalized by that spell that happened. I'm interested to see if anything like that comes in the next couple of years from this, and what that looks like for people that lost their job, didn't make payments when their forbearance or credits destroyed. Are they going to come up with a HARP-like program for that, or are they is that just going to be shit out of luck for a massive amount of people?
I think they're going to be shit out of luck personally. I mean, obviously you're asking Kevin. Kevin, you're on mute, but like, I think you're shit out of luck. I don't think there's any relief for that.
I don't know. I think the government. I think the government loves making money, and I feel like they probably don't want to create a HARP program again, but I could see it happening. I could absolutely see it happening again. We're going to have stimulus 4.0, and possibly even a fifth round. I mean, there's another bill on top of the $2 trillion stimulus package that's being put together on the Hill in D.C. I was on a Mortgage Banker Association call this morning for wholesale lender executives. Thank God for the MBA. I mean, thank God.
They're doing a good job, by the way. They actually stepped in and they're really killing it. I'll be honest with you. What's going on with all that, by the way? What are they fight? What are they fighting for? What are some of the things that they're trying to get accomplished right now?
So the stimulus package that's in the works right now is some of the big things they're fighting for is to make sure that there's more liquidity, more facilities and liquidity for servicers, which will create stability, which will ultimately create better interest rates, lower interest rates for consumers going forward. And so that's a big thing. So more clarity on getting some liquidity for servicers, specifically servicers for Fannie Mae and Freddie Mac, conventional loans.
Yeah.
And they're working on a remote online notarization bill. And that's a big part of that bill. So example, like all these title companies are closed, because everyone's sheltering in place. But, you and I, we're all trying to get more loans done. So how do we get more loans done if we can't, if the title company won't, if maybe they feel, there's a COVID-19 scare,
Well, that's the beauty of what's happening.
That's one of the harder hit areas.
That's the beauty of what's happening is it's forcing that. Like people don't have to be together to do a closing, right? Like you don't have to be, and there's a lot of people that are going to resist that because they're a closer or they're like, but you've got to adapt. And the market right now is like doing what it might have done in 5, 10, 15 years in like 30 days, right? On some level. It's interesting.
Yep.
To see that.
Well, I'll give you an example. We had on our roadmap, for Q3, Q4, we're like, all right, let's roll out this e-hybrid closing solution. It'd be kind of a cool way to have a better experience at the closing table. It's not a necessity. It's not even the majority of how loans, get done, but we all kind of agree it's the wave of the future.
But we got other things. Our company, we just rolled out a new streamlined loan estimate for wholesale. We just rolled out a whole new appraisal ordering system for the entire company. That's in pilot right now. So, did we also want to roll out e-hybrid closing? No, not necessarily. Oh, but wait, all the title companies are closed? Okay, I guess we'll move that project forward.
There's opportunities right now. I think the people that, like you just were mentioning, like, you're adapting, right? You're looking forward. You're looking for the holes, and there are opportunities right now for anybody in any industry. I see real estate agents, getting business right now, and I see other ones just laying there and kind of taking it and saying, I can't do anything, right? So
I think a lot of the innovation, though, is going to come or can only advance when the government updates their antiquated systems, like recording, right? And the IRS and getting tax transcripts. Why does it take 5 days?
Wow, you hit that one on the head, man. Sal, you could not have hit that one on the head better.
I mean, it's just like, how can we if we're able to get those parties on board, right? The municipalities for recording or pulling title work and things of that sort, and largely the IRS for verifying income. It's almost bad for loan officers because it's one person will probably be able to do the work of two, but the ability to get loans done faster, efficiently, and with less contact and less errors will greatly increase. And hopefully this brings about some change with that. Like, hey, the IRS offices are closed. We're not able to obtain tax transcripts. What do you do in that situation? Right?
Yep. Yeah, we just basically said, look, we don't really need them. I mean, we're just basically, unless it's, I guess, a self-employed borrower, it's really the only time we really, really need them. And so, borrowers can go online and pull their own transcripts off the system. And, so that's kind of like our workaround, but yeah, I mean, it's been brutal that the IRS offices are closed.
It's been brutal with the IRS offices open and in full, I mean, it's just a fucking nightmare. So hopefully, this brings about some innovation, but I think it also brings a lot of opportunities too in the future for underwriters, because what we're all expecting, rates to be low after this is all said and done, right? Or at least being there, I think that $6 trillion worth of loans to be refied will slowly start trickling in. I think lenders at that point, their only problems will be capacity, not necessarily cash, right?
Yeah, I agree. And that's what we want to be, well, I mean, I still think you can overload your own cash depending on, I
not
hear
like this situation, right?
Yeah. You know what? But some lenders out there, they're just kind of dumb. They're not making money right now. Like they may not, they're doing loans and they think they're doing record volume, but they're not actually making any money. And so, that's a drain on capital too, running a bad business in addition to margin calls and all the crazy stuff. But, I would say the other big thing to come out of the Mortgage Banker Association and where they're hitting us is to get some more certainty on this forbearance policy. Right now, this is interesting. So if we close and fund a Fannie Mae loan, let's say it has day one certainty, right? So Fannie Mae is able to verify the borrower's job and employment through day one certainty. We do our VOE, on top of that within 3 days, and we do verify that borrower did not lose their job. I mean, look, if we're at 20% unemployment, we're still at 80% employment. So, if you're one of those borrowers,
I said the same thing. Yeah, there's still a lot of people working, right?
Right. So, have a conversation with your borrower. Say, look, if you're not working or you plan on doing a loan and then going into forbearance, don't get a loan. Like, just wait. Like, trust me, a mortgage is a massive, major obligation. Trust me, there's no free lunch. You may not have to pay for a few months or up to 12 months, depending on how long this thing lasts, but you still owe that money. There's no free ride. It is not forgiveness. And so what's interesting is Fannie Mae basically said, all right, well, they're kind of unclear. It's like, if a borrower is inquiring about forbearance, we don't want that loan. So we're like, hold on a second. So we're doing your loan that you've asked us to do in the manner you've asked us to do it, getting a VOE within 3 days, and then you gave borrowers the ability not to pay. And then when they ask us not to pay because you allowed them not to pay, and they tell us they don't want to pay, then we can't sell you the loan.
That's super fucked up. I didn't think about that.
So, dude, it's crazy. So if there's one thing that Mark Calabria, the director of the FHFA, which is, the regulator of Fannie Mae and Freddie Mac, just come out and say, look, you know what? If you've already closed and funded the loan and everything met Fannie Mae guidelines by the time you dispersed funds, if the borrower truly is in need, they lost their job after the fact, or or they requested forbearance because we said you could have a free ride for 12 months, you could still sell us that loan. Like it's what it is. We're providing liquidity. It's what it is. It's actually unclear.
It's not clear. Yeah. That's tough. It's tough.
And uncertainty makes rates and rate sheets not as good as they can be for consumers and taxpayers.
Yeah, and that's what I think a lot of people. Oh, sorry, Sal, just real quick. That's what people need to figure out is like, well, they should be lower. And I heard this person is doing this, and that person is doing that. I'm like, dude, it's fucked up right now. Like, I don't know.
The amount of complications and layers of risk obviously being added are crazy, right? But like for us, like a mini core, right? Like borrower was employed and had a VOE that was active the day of closing, right? It takes 2 or 3 days potentially for the package to be received by a closing department, and they're requiring a VOE after the package is received to be active before they purchase the loan, right? So how in God's name could we control a purchase that funded and then over the weekend, or, depending on the lender's turn times, let's say 5 days later, they get laid off and now we eat the loan,
Yep.
I mean,
you guys have the most risk,
Right.
You guys actually, the loans you guys put on your warehouse, because you guys, you're in the community, you have your warehouse line, and then you're turning around and selling it to a non-delegated correspondent lender, which a lot of them are also turning around and then selling it off either directly to the cash window, which is what we're doing. We're just servicing it ourselves, or we could have in the past we've been selling it to aggregators. But aggregators are telling us exactly what your lenders are telling you, which is, dude, by the time we look at it, if they're not employed, we're not buying it. It's
Right.
like you get stuck. You guys get stuck with it. So
We get
you do.
Brutal.
and we're not a servicer.
We can't service it. What the fuck are we gonna do?
No, I mean, and then your warehouse sign is gonna go, hey guys, line's getting a little full. We're gonna need you to put 10% down on every loan that's been on there for 30 days or longer. So now you guys got to pay curtailments. And so,
Kevin, this is how we met, by the way. This is exactly how we met.
I told you, man, we were rocking and rolling. I was like, send us the loans, we'll bail you out.
Good, man. You were good. Like, we had a moment where we were really kind of freaked out, just to be fair. And I was like, what the fuck am I going to do? And I got on the phone with Kevin.
You still should be.
Yeah.
Oh,
yeah. No, I'm still freaked out. But at that moment, it was like, that was a real bad one. Right. But I think for us, we're like, dude, we're going to just broker what we have to broker right now. And we're being very cautious. At one point we said, we're not taking any more we couldn't give our clients good information. Right. I felt like it was irresponsible to put someone in process with so many unanswered questions on some level, because I, in my opinion, and I could be wrong, that on the other side of this, the rates are still going to be really low. And so you're not missing an opportunity, but putting you through a process right now is just going to be such a bad experience, even if you do get it closed. But if you don't, you just don't know. There's too many unknowns. So how do you put someone through that?
Yeah, I agree with you 100%. And the reality is, no matter the size difference between, your company and our company, we're in the same boat.
Right.
The uncertainty comes straight from, Fannie Mae and Freddie Mac. They're not telling us, exactly how they are going to purchase and handle loans for borrowers that even request a forbearance, much less actually are in it. And so one thing we did, and I'd be happy to share with you on email, we created a COVID-19 addendum, and we make every borrower sign on every loan. It basically says, they check 3 different boxes, and then they sign and date, and they say basically everything on the loan application is true. My employment and income is accurate, and I do understand and intend to make my payment. So now the way I worded that is very specific. We're not trying to discourage people who truly need forbearance. We're not discouraged. We didn't bring up the word forbearance. What we're saying is, you intend to make this payment. You know what it is. Okay.
Yeah,
And your income and your job is what it is, and everything's accurate. I mean, that's what loans are always like anyway. Virus, no virus, all is right in the world, doesn't matter. Borrowers do a loan, they're supposed to make the payment. No borrower should be doing a loan where they don't intend to make the payment. And so that's just not. So I'd be happy to share that addendum. And look, if you get a borrower that gets kind of squirrely and says, well, I heard, I can get some free payments. Don't do this loan. Like you said, rates are going to be great later. If you have a problem not making this payment, don't do a new loan. No one in the industry wants a loan where a borrower is not going to make their payment right off the bat.
That's awesome. So, I mean, we've been long, so I want to get to our 3 questions. We do it on every show. So we're going to ask you 3 random questions. And first and foremost, Kevin, thank you for doing that. Dude, your knowledge is really, really vast. And I would love an opportunity if something comes up that you could come back and talk to our audience and tell them what's going on.
Yeah, that'd be great. This always changes every day, man. So anyone can go to my LinkedIn page, and I put out daily videos, man, just like you guys are putting out content as well. So
and your videos are really important. I mean, you did one last night at like 3 a.m.
Oh,
Why were you at 3 a.m., by the way?
Man, it just was one of those days, man. It's like, it's just so busy right now. There's just so much going on. And I don't like leaving anything undone when I leave at night. And so I wouldn't even be able to sleep if I had an unread email. So it's just a lot. It's just one of those days.
Yeah, I get it, man. I totally get it. All right. So we're going to do 3 questions. First one's always the same for a new guest. And that one's going to be, what scares Kevin?
Gosh, you know what? I could go full Sicilian machismo and say nothing scares Kevin, but honestly, man, the thing that scares the shit out of me is I have 4 kids, and like any one of them getting hurt.
Yeah.
It just like I'm not a helicopter parent. We have 4, like 7, 4, 2, and 1, 3 girls and a boy, so, but just the thought of them just like falling off the tree in the backyard and breaking their arm or anything like that, that scares me so much. Like anything else, no big deal. But that because they're so defenseless and they're helpless and they don't know what they don't know.
Right. Next question is going to be, if you could eat only one meal for the rest of your life, what would it be and why?
Man, P.F. Chang's Mongolian beef with white rice is
Mongolian beef is right. Mongolian beef is right. It is so right.
So high on the list. Thai food, chicken pad see ew is right.
But every day though, for the rest of your life?
I think I would do chicken pad see ew only because every day red meat, I think I would die sooner. So I like if you guys like Thai food, I know everyone gets like the classic pad Thai. Don't sleep on pad see ew. It's like
pad see ew.
So money.
Pad see ew is heaven.
It is, dude. It's like a sweet soy sauce. So there you go. I'm a pick.
Yeah. Brad sounds like he's like in World War IV.
But by the way, I think if you ate pad see ew every day, you'd be probably dead pretty quick too.
I know.
It's like Thai pasta.
Yeah. My dead Sicilian grandmother is rolling over her grave right now that I didn't pick anything Italian. But at least there's pasta in there.
Yeah.
All right. I've got. Anybody else have a question they want to ask?
Man.
Sal,
just to keep it on a non-serious note, if you could be one animal in the animal kingdom, what would you be?
Oh, lion, 100%. Dude, I'm like.
Hell yeah, bro! Look at that. Yeah, just like us. Yeah, there we go.
Brother, I'm a Leo. My rising sign is Leo. My dad's name is actually Leo. Like, yeah, I'm all about the lion, dude. You see that meme that comes up all the time, like, which animal would win? It's like a bear, a lion, an alligator, and like a boa constrictor. I'm like, dude, the lion would destroy all of them, like hands down. Like it's not even close.
We got to get this guy some Omega gear. We'll send you some in the mail.
Bring it, dude. I'll wear it.
That's awesome. That's it, man. That's the show, dude. Thank you. Honestly, like I can't again thank you enough. Anything you want to say before to our audience before you go?
Well, just I can say this. When you deal with guys that are in the community, lenders that are in the community, professionals like the gentleman here, I mean, that's the way to go. I mean, these people, they have the best of both worlds. They know what they have options. They're having guests on their show to give them information. most average originators, they're not even digging in this deep. They're just trying to figure out, how the hell do I, get through this mess? But I will say, I love this country. I love Americans and our resiliency. We're definitely going to pull through and get out of this crazy, stupid pandemic sooner rather than later.
Bat soup, dude.
Bat soup, dude.
Yeah.
Pray for a super hot summer and kill this virus.
A hot girl summer is what I want. Oh, I'm sorry. Listen, everybody that's listening, man, we really appreciate you guys taking the time and listen to our show. But I from all of us to all of you, hopefully everybody's being safe. Stay away from me and my family if you can. And then we love you all. Bye, guys.
Cheers, guys. Thank you.
Bye, guys.
Bye.